Today I'm going to talk about whether Singapore savings bonds, SSBs, are still relevant now that their rates have gone down and oversubscription has ended, and bank accounts are giving almost 5% per annum interest, fixed deposit and T-bills are around 4%. Does it still make sense to get SSBs? Let's find out. Now remember August 2022 SSB where it was super oversubscribed and we got like $9,500 maximum? Those days are long over because February 2023's SSB saw an underwhelming subscription rate with just around $400 million of the $700 million offered subscribed. And this is a break in the trend of oversubscription we have seen in the past few months. With March SSB under 3% per annum average returns, even if you hold it over the 10 years, I think oversubscription is not going to be a thing anymore and you can get as much SSB as you want. But the question is, does the unpopularity mean that SSBs are no longer worth putting your money in? Months ago, when SSBs were very popular, I put out a video talking about the downsides of SSBs and how to manage them. And let's revisit that video to see whether or not things have changed. And I think some have and some have not. Do me a favor and tap the like button down there. It takes you half a second, but it greatly helps out this channel. Thank you so much, and back to the video. The first downside of SSBs back then was that it was difficult to invest a large amount of money, and this is obviously not true now because you can invest as much as you want provided your total amount across all your SSBs are under $200,000 per individual. So of course, if you want to invest more, you can get a trusted relative or friend, but at your own risk. Okay, my point being that you can now invest significant amounts of money in it without worrying whether or not the ceiling amount is going to be something lame like $9,000 or $14,000. And if you really look at the returns for February or even March 2023's SSB and you compare the rates to August 2022, the rates for Feb and March I think are actually better than that of August 2022. So if you are still holding on to an older SSBs and have not actually refinanced it, meaning to say to sell off your old SSBs and then buy the new ones, it's actually quite worth doing so, and you can now buy a larger amount because there's no more ceiling amount that will happen moving forward, at least in the near future. I also mentioned back then that the coupons are not reinvested, so you actually get them on every 6 months, and then this money tends to be sitting around in your bank account earning low interest, and that actually is also resolved because bank accounts now are giving high interest. So if your coupons are credited to your UB1 account or your OCBC 360, you get the 4 to 5% interest those accounts offer. So it is also now not an issue. Getting coupons like that is actually a welcome feature for some because you can take it as income, much like dividends do. So yeah, I think this one, it is not so much of an issue rather than something you need to take note of. The coupons need to be managed, and if you manage it well, yeah, you can just use it in your favor or right now leave it in your high interest bank accounts. The withdrawal mechanic is completely unchanged, of course, so you still need to manage it accordingly and not dump all your emergency savings into SSB. Even though it's almost completely liquid and you can withdraw any time of the year, it is still subject to the withdrawal timeline, meaning to say you can only get your funds at the start of each month. So you do need to prepare some amount of very liquid emergency savings because emergencies by their nature are unpredictable. Some people tell me you can just put 1 or 2 months worth of expenses aside and then keep the rest of your emergency savings into SSBs. And this, I think, depends on your risk appetite because to me, 1 month or 2 months assumes that your emergency only requires 1 month worth of funds, but it may be something that you just need more funds with. And yeah, unless you have relatives to borrow from and you're willing to do so, I would tend to be a bit more conservative. I will put at least 3 to 6 months, okay? But it is your call to make, right? Just be aware that SSBs still have this withdrawal mechanic that you have to abide by, and funds can take as long as 3 to 4 weeks to reach you if you withdraw at the start of the month. You have to wait until the following month to get your funds. Weibo has refreshed its promotion and reduced significantly the amount of money you need to fund your account from $2,000 to just $100, and you just need to maintain this amount for 30 days. Now, I would suggest funding at least 200 Sing dollars because you need to buy one stock worth at least 100 USD, and after that you get 100 USD worth of cash vouchers. And this is a very generous sign up promo considering your small capital outlay as well as the easy requirement of just buying one US stock and one option. On top of that, you just need to buy and maintain one mutual fund for only 5 days, and you can get a chance of winning anywhere between 8 to 1888 USD worth of Apple shares, So I hope you get really lucky, and I think you would if you use my link to sign up for Webull. It will keep my website and YouTube going. So thanks so much for signing up, and thank you Webull for sponsoring this video. Finally, I mentioned that SSBs are too conservative and you should not put all your funds into SSBs and take it as your main investment vehicle. This point still remains. I think the use of SSBs now is again to store part of your emergency savings for the long term, and it should not form your overall investment strategy, particularly for people who are still in their 30s, 40s, and still working and still some time away from retirement. Now that I've covered the cons, what are the pros of investing in SSBs? The number one pro of investing in SSB is that it is very liquid compared to T-bill and even fixed deposits. Now, even though the tenure for T-bills can be very short, between half a year to 1 year, you are unable to terminate it before its maturity, and you have to sell it in the secondary market if you urgently need the money. Now, this can pose some problems because number one, if you sell, you may not be able to sell because there's a very bad liquidity in the secondary market. Nobody wants to buy your T-bill. Number two, you actually might have to sell at a capital loss if that is the case where your T-bill that you're selling is just not attractive to investors. And therefore, these are some liquidity issues that even short bonds like T-bills face. For fixed deposits, you will get back your capital when you terminate. Please check your terms and conditions. I think that should be the case for all fixed deposits, but I'm not 100% sure on this. But generally, you will get your capital back. And some banks even give you a small amount of interest, but it's generally not prorated to the amount that they market. Usually, you do lose quite a bit of the interest that you stand to gain if you terminate before the tenure is up. SSBs, on the other hand, you can withdraw once a month and your returns are prorated down to the month that you have put it in, meaning to say if you put it for 5 months, you actually do get 5 months worth of accrued return disbursed to you if you terminate your SSBs. And you can even withdraw in multiples of 500. So you don't need to withdraw your whole amount if you don't want to. And that's not something present in T-bills. So SSBs are great for housing your emergency savings. Of course, number one would be bank because it's fully liquid. Number two, SSBs. Number three would be fixed deposit, and number four, T-bills. T-bills are the worst at keeping emergency savings. So SSBs are still useful for emergency savings, and despite the lower interest rates, I think you should consider putting your emergency funds into that rather than something like T-bills, even though T-bills do offer a higher interest rate at the current moment. The second pro of SSB is that the rates are published at the time they are launched for sale, and you know exactly what rates you're going to get down to the cent. Whereas for T-bills, you have to auction for it, and on auction day, wait for the price to be reviewed. So SSBs also give you a long 10-year guarantee on all these interest rates, which other instruments don't really match up at all. T-bills, of course, only for 6 to 12 months. Fixed deposit, the longest I've seen is about 24 months, and I'm sure there are 3-year ones, but the rates are not that attractive. And yeah, beyond that, you have to be subject to the prevailing interest rate at that time. And therefore, if you're looking for something to put your funds for 5, 6, even 10 years, SSBs give you that unique advantage that other instruments can't quite match up. Buying SSB is also a hedge against interest rates falling sharply, and that might not happen in the next 1 or 2 years, but let's say 3 to 5 years time, will interest rates go down to a point where SSBs at 3% become very good again, like what we've seen last year? That's actually a very possible case. But of course, if you wait till 2-3 years to do it, SSBs at that time will not give you such high interest rates. And of course, the T-bills, fixed deposit, and bank accounts at that time will also offer you quite lousy rates. And therefore, you have to make up your mind now. Do I want to lock up some money now in a 3% or so return where everything else is at 4 and 5%, so that in future, when everything else dips under 3%, I still have this 3% to enjoy? That's something you have to consider, and of course that depends on your outlook, your risk appetite, as well as how long can you not touch these funds for. Now, what I will do is I will put some amount of emergency savings into SSBs to be locked away for the long term. Now, not only does this lock in some interest rate for some of my funds, I think by putting aside some funds over there, I'll be too lazy to take it out, and it becomes a form of forced savings for me. And also, it will form a little bit of my bond allocation for the next 10 years. So that is my personal take on the situation. Secondly, I think people who are very conservative and you really do not want to invest, SSBs remain a very unique vehicle where you can get around 3% return right now and you still enjoy liquidity. So there's very few instruments, and in fact, I can't think of anything that can offer you like for like features, right? Almost full liquidity and still guaranteeing you a rate of 3% for the next 10 years. Yeah, so these are the two cases I see for SSB. Again, one, emergency savings, two, bond allocation, and oh yeah, number three, very conservative investors. So what do you think of SSBs? Are you going to put more money into it? Are you going to hold your SSBs or are you going to sell your SSBs? Let me know in the comments below because I always learn so much from my own comment section and also my Telegram group. Speaking of which, join my Telegram group to get updated on financial content, deals, and interact with other people who are also very passionate about all things finance. Right, you will learn a lot of things there as I do. And also tap this video to look at the downside of SSBs in greater detail. And also this video on T-bills or something else that YouTube thinks you like. See you in those videos.